Good evening, everyone. Thank you so much for taking the time and joining on the call. Uh, I'll quickly take you through what we have in store for today. We'll start, as always, with a quick 2-minute update on our products and the performance. We will then head over to the key discussion, which is the Fident Fine Print Edition 3, where we want to take you through the exchanges and where we see opportunities. Thirdly, we will just cover a quick market outlook in terms of where we see markets are and what our advice to investors is. And we'll then open up for questions and answers. So, without any further ado, let me quickly give you an update on our funds and our recent performance. And I think this is a very timely period to share this, as both our flagship funds, Fair and Fiber, have now completed 2 years of track record. So it's a fairly decent time frame in terms of measuring performance now. In terms of the performance, as you can see on the screen, for both strategies on a since inception basis, we continue to generate alpha of anywhere between 6 to 7% on an annualized basis, net of all fees and expenses. And I think it's important to highlight that while 2 years is not a big time frame or a long time frame, but I think we take a lot of pride in sharing that given how challenging markets have been in the last 2 years, I think it's worth highlighting that the performance has been very, very strong despite challenging market conditions. So that is a quick update that I wanted to start with. And while absolute performance is good to track, the question that investors and distribution partners alike also want to understand is how are we doing vis-a-vis our competitors and peers. So that is what I wanted to cover next. In terms of our performance, if you see, and again, we've chosen publicly available mutual funds that a lot of you track and invest into, which very closely reflect our strategy. So this is for our flagship fund Fair, a comparison with FlexiCap and focused funds. FlexiCap, of course, because our strategy is FlexiCap, so it's directly comparable. Given our portfolios tend to have anywhere between 20 to 22 stocks, we also have added focused mutual funds to the peer set as comparison. If you compare performance at around 12.6% per annum, we are roughly 5.5% higher than the average mutual fund. When you compare to, and 5 to 5.5% is a broad range, whether you take flexi cap or focused funds. Our rank in this peer set, and these are all since inception returns and ranks, we rank first amongst 40 mutual funds and second amongst 29 mutual funds. And this is, I'm taking the liberty of sharing this because this is something that we also track on a very, very regular basis. So just thought I will add that in addition to the performance. For those who would not have heard of this, let me spend 30 seconds on giving you a quick recap about both our products. The first one is FAIR, which is Fident All Season India Resilient Portfolio. This is a flexi cap portfolio which blends its allocations across growth and value stocks and has the ability to move across market capitalization, large, mid, and small caps. The objective is for us to beat benchmarks and comparable peer products by anywhere between 4 to 600 basis points, which we've been doing since inception. The second strategy is called Fiber, Fident India Builder Equity Portfolio. This is a very true to label thematic portfolio where we invest in 6 themes that we have identified, which are beneficiaries of government reforms over the next 3 to 5 years. So, those are the two products. And just to recap, in terms of portfolio positioning, we mention a range of anywhere between 15 to 25 stocks. Today, both strategies have 20 to 21 stocks. We have zero overlap between both funds. By the very nature, the products are designed very differently and have very, very different, target investment universes. And we don't take any cash calls across our funds. So that was a quick recap in terms of the products and the performance. With this, let me quickly hand over to Mihir to take you through our assessment of the exchanges landscape, how we fare versus global peers. Over to you, Mihir.
Yeah. So first of all, before starting with a note, I would just put up on the investment philosophy at Fident. So our investment philosophy is fairly straightforward. We like businesses which are very difficult to be disrupted, which are efficient capital allocators, and where we see a favorable risk reward. So What I mean by strong capital allocation is ROIC is above our benchmark of 15 to 20% plus. Favorable risk reward is when the valuation matrix comes into play. And difficult to disrupt business is something which we actively work on. So when you look at the entire India investment portfolio or investment landscape, one segment which kind of pops up. No, no. Let's stay on the first slide. One segment which really pops up is the capital markets. So capital markets, when I look at it, point two and point three, which is capital allocation, favorable risk reward, robust cash flows, competent management, we'll find a lot of companies doing that. However, the most important metrics to track in our assessment is the ability to be disrupted. And that is where we prefer exchanges over a lot of other segments. I'll give a couple of examples for you to get a glimpse of how or why exchanges are our preferred pick within the capital markets. So let's look at AMCs or stockbrokers where there are a lot of peers which are already listed. So there are currently 47 AMCs and more than 1,000 plus brokers registered with SEBI. On the flip side, there are only two major stock exchanges who are actively trading, three if I'm pushing it. The barriers to entry for an AMC or a stockbroker is materially lower than a stock exchange. And with that, what happens usually is over a decade, you will see a lot of market share shifts happening. So, for example, in brokers, you started with a lot of bank-based brokers who got disrupted by Zerodha. Zerodha got, in fact, disrupted by Grow, who will probably be disrupted by some new age broker in the next 5 to 10 years. While exchanges, I have a very interesting stat. So, if you look at the top 20 global stock exchanges in the world, the median age of a stock exchange is more than 100 years. In fact, when I was going through the list, I was surprised to see the youngest stock exchange is actually NSE, which is in fact 30 years old. So, despite all the internet age, AI age, this segment has been the least disrupted of the lot. The oldest stock exchange actually is more than 400 years old. So, when you look at the overall stock exchange, we like stock exchange because the barriers to entry are very, very strong. Most of your capital intensity is already deployed. You have already built the platform exchange. And when the market turns, you have exceptional operating leverage. With this, I'll just move on to the investing landscape in India to see where each of the companies are. So if we look at, I think, and this is probably the most impactful slide in our presentation. So I'll take like a minute to kind of explain what it is because there's a lot of data, but I would really appreciate if we try to keep it as brief as possible. So the amount in blue is basically the revenues of each of the companies. Within that, especially on the stock exchange side, we have broken it into cash, derivatives, and others. And of course, in derivatives, we also further broken down into options and futures. The amount in orange is revenue as a percentage of its overall revenue. So, for example, 1,555 crores is 9.5% of NSE's revenues, or 250 crores cash revenue is 5.5% of BSE's revenues. And probably the more important element to kind of track is the market share, which is what we've identified in bubbles. So, Indian exchange is around a 25,000 crore odd market size, broadly split into stock exchanges and commodities. Stock exchanges being a fundamentally larger part, almost 22,000 crores, and commodity exchanges are significantly smaller. In stock exchange, when we break into stock exchanges, there are two large exchanges which we are all aware. NSE has around 16,500 crores odd revenue, BSE closer to around 5,000 crores, which is like a 77 and a 23% kind of split. Cash segment, which is less than, I would say, 10% of revenues for the entire segment, there NSE continues to hold upwards of 90% market share. But I think where there is substantial interest and which is also a significant part of overall revenues is the derivative segment, which contributes around anywhere from 2/3 to around 70% of overall revenues for the entire Indian stock exchange market. That is where the option market NSE has now 73% market share, while BSE has around 27% odd, and futures where NSE has more than 99% market share. Moving on to commodity exchanges, we broadly split into two. There is power exchanges where we have Indian Energy Exchange, PXIL, and HPX. this IEX has around 83% market share, PXIL is around 10.5, and HPX is around 6.6. This is the segment which we see will be the most disrupted in the next couple of years, primarily because of the decoupling loss by the CERC. And metals and agro exchanges, when you look at it, I think MCX has been the clear leader, around 96% market share, almost a monopolistic position in all major commodities, including gold, silver, crude oil, and copper and other small commodities. While NCDX is primarily an agri exchange, focusing on a few commodities like guar. And it's whenever we're doing Indian exchanges, it's always important to compare them to global exchanges to see where we actually stand in the global side of things. So moving on to the next slide, when we look at other global exchanges, NSE has around a 3% market share. This is a revenue market share. So around a $1.7 billion revenue for NSE. When you compare it to large stock exchanges, Nasdaq, NYSE, CME Group, London Stock Exchange as well, NSE is still a significantly smaller player in terms of the global scheme of things. So, and actually, when you compare the number, I think India's 3.3% global market cap is broadly mirrored by NSE and BSE's share. So, what is very likely to happen as India moves to number three largest economy by 2032? We expect this number to inch up to around 5%. So, amongst the global stock exchanges, I think NSE and BSE would probably be the best placed global stock exchanges to kind of invest in the coming future. Similarly, on the commodity exchange type, MCX, I was very surprised to see the stat. MCX is almost as large as London Metal Exchange, and that is primarily because MCX works on a per contract revenue basis versus LME is fixed price per contract, and that is why we've seen a material jump in MCX. However, when we go into individual companies, we are a little less enthused about MCX versus the other stock exchanges. Moving on to the next slide, we have a few business models when we compare each company to Indian companies to other exchanges. So while optically it looks like NSE's major peer should be New York Stock Exchange or Nasdaq, the truth is that's not the case. So let's bunch up both this slide into two parts. So the first part is the first four exchanges, which is the Hong Kong Exchange, London Stock Exchange, NYSE, and Nasdaq. They contribute their revenues contribution is primarily driven by cash and listing fees, which is cash and IPOs getting listed on their exchanges, where I think anywhere from 40 to 80% of their revenues come from this. While if you look at NSE, BSE, and the CME Group, so CME Group, I don't think so a lot of people would be aware, which is the Chicago Mercantile Group. That is the world's largest derivative exchange. I was surprised to see such a strong correlation between the CME Group and the NSE and BSE's revenue. So the dark green slide, the dark green chart which you are seeing, that kind of showcases that Indian exchanges are more derivative exchanges than stock exchanges for that matter. And that is where I think a lot of focus should be on tracking that number rather than cash or other numbers, because that is going to be the material driver for earnings acceleration or deceleration in the coming years. Moving on to the next slide, I think the more importantly, so while we've spoken a bit on cash and derivatives, it was also I would say conducive to kind of split NSE and BSE into subsegments which are not part of the global benchmarks, but they can become, like, I would say, dark horses in the long term. So for example, for BSE, Star MF, which is a unique line item which almost contributes around 6% of overall revenues, that is a very unique, I would say, stock exchange revenue driver for BSE, which is very different from all other stock exchanges listed worldwide. While similar, if I look at it for NSE, data and connectivity, which is almost 12% of revenues, and that has been growing at a significantly higher pace. These are the two dark horses which can become material contributors to revenue over the next decade or so. With this, I think we'll move on to the individual stock exchanges, and I'll hand over the mic to Bhavin to take you with for NSE.
Thanks so much, Mihir, for that. So let me quickly take you through the big discussion point, which is NSE and its proposed IPO. So let me quickly cover two aspects with regards to the IPO. One is, of course, a brief on the company and what the key drivers in terms of revenue and growth are, and then come to the IPO. So when you look at the overall background of their market share and revenue, and as Mihir had alluded earlier, if you see across segments, NSE continues to be the market leader, be it cash, futures, and for options, of course, we've noticed and seen that their market share has gone from 99 to around 75% till date. But what we also must notice is they've also gained market share in several segments. Like currency, they now have a close to 99% market share, both on the futures and the option side. So, in terms of market share, I think it's very clearly visible that NSE is the undisputed market leader across segments in the capital market ecosystem. So that is, I think, a good start point. Now, if I come to the overall revenue and how it has grown over the past few years, predominantly, if you break the revenue, and Mihir took you through granular data, but if I just take two broad classifications, I'm looking at transaction charges and then the other revenue matrices. So if you look at transaction charges, that constitutes about 80% of the exchange's revenue. So let's look at how transaction charges have grown in the last 3 5 years. In terms of the overall growth, I think they've grown at somewhere in the 9 to 10% range, very, very well spread out in terms of cash, options, as well as futures. The options growth, as you can see at 7% annualized, is slightly lower because of them losing market share from about 99% to 75%. So this is how the transaction volumes have grown in the last 3 years. The more interesting area is the others, which contributes about 20% of the revenue. This includes a whole host of revenue sources, and this has been growing very, very strongly. So if you look at the last 3 years, 4 years between FY23 and 26, these have grown at close to 28% on an annualized basis and now form about 20% of the overall revenue pool. These are diverse sources such as basic fees, revenues on any IPO or any new listing coming, to data centers, connectivity, etc., etc. And this is one area which, like Mihir mentioned, it's very, very important for exchanges to sustain growth and find these new areas like BSE did with Star Mutual Fund. We see a lot of similar initiatives being taken by NSE, and they are showing significant growth as well. This growth we anticipate to continue because they are also making incremental measures to introduce newer contracts and enter newer markets like electricity, crude oil, coal, bullion, and so on and so forth. So these, and again, I'm just trying to give you a sense of what is the potential growth that may come in. If you look at on a consolidated basis, this is about a 3,000 crore potential market size. So any attempts by NSE to launch products here, gain market share, will again assist the growth of the other income. So that is the revenue profile and how the two segments, which is transaction charges as well as other revenue sources, have grown. Now, coming to quickly the IPO. This was a brief on the business. Now, let me quickly jump over to the IPO. As you know, NSE does not have an identifiable promoter. The shareholding is fairly diversified. We've just placed the top 10 shareholders prior to the IPO for your reference, led by LIC, SBI, Stock Holding, and various other capital market participants. We've also seen the details of the shareholders who are participating in the IPO. So those are also clearly listed out. Roughly about a 30,000 crore IPO is what is in the works. In market share terms or in market cap terms, it's value-wise 30,000 crores. In terms of the equity, that would be translating to about 6% of the market cap of the exchange. So that is a quick overview on what the IPO looks like. Now let's look at valuations. And of course, given NSE's imminent listing, the easiest comparable is BSE. So if you look at the multiples and the valuations at which NSE trades vis-a-vis BSE, if you take the last 4 quarters or the trailing 12 months, NSE at a rumored IPO price of around 2,000, which is roughly what multiple sources are reporting, It trades at about 47 times its last 12-month earnings, vis-a-vis 63 times for BSC. While this may appear to be cheaper, it's important to look on a forward basis and see how this looks on a forward basis. And for that, we also need to understand the growth trajectory of the two companies. Now, again, in the last 4 years, while NSE grew profits by about 12%, BSE, aided by its gain in market share, posted a superlative 124% CAGR in the last 4 years. We do expect this to moderate. So, on a going ahead basis, we expect NSE to grow by about 21% and BSE to grow by 30%. So, if I take that growth into account, I think both exchanges trade fairly similar in terms of their FY 28 earning multiple, which is anywhere between 35 to 37 times. And with this, it's now important to look beyond FY 28. So, to our mind, I think the key data point, of course, to track is how the options market share goes further. We've seen BSE gain significant market share, but whether they continue to do that is one of the key data points to track on a going ahead basis. So this is, of course, on a valuation and a fundamental standpoint, how NSE and BSE compare. I think it's also very, very important, and we've seen this with a lot of recent IPOs come. It's also important to understand how the demand supply dynamic works. So let's spend some time there as well. In terms of the and like I said earlier, the fact remains is that NSE has no identifiable promoter. So one may argue that the entire market cap of the company over a period of time will be available to trade on the exchanges. So we've just gone in time and broken this into two parts. The first 6 months post listing, let's understand demand supply at that point of time and then go forward. So if you see the first 6 months, most investors will actually be locked in prior to post the IPO. So they will not be able to offer their shares. So for the first 6 months, let us try and understand what is the potential supply that can come to the markets. And this is a very, very comprehensive exercise that we had done. We've analyzed a large majority of the shareholding. The data is available on the DRHP. So if you look at it broadly, on a technical basis, about 5.48% of the shareholding in NSE is technically sellable in the first 6 months. The balance is not available to be sold because those shares will be locked in. We've also tried to map out the majority funds and owners and holders of these 5.48% stake. And let's just conservatively, on the side of caution, assume that about 50% of this potentially is the supply that may come into the market. So if I take a roughly 2.75% equity supply, at a 5 lakh crore market cap, which is again what we are hearing in terms of the valuation of the exchange, that comes to about 14,000 crores of potential supply. So that's, in our assessment, the potential supply that can come in the first 6 months post listing. Now let's flip over to the demand side and understand how the demand will pan out. So firstly, let's look at two parts to the demand. The first is the passive flows. And again, it's taken a lot of work for us to understand how the large indices will treat this IPO. It's in many ways, in many sorts, this is unprecedented because the size of the company and the fact that NSE itself is an exchange has various nuances in terms of other exchanges recognizing it and including it in their indices. But if I go index by index, let's just first look at FTSE. The FTSE, the first potential date on which it will be included in the indices in our assessment is 5 days post listing, which is if the FTSE uses the fast track mechanism. Uh, to our mind, I think this will get triggered given the size of the company and its potential free float market cap. We've also mapped out future dates. So, as you are aware, every index has a potential rebalance and review date. We've also mapped and seen what the potential changes will be on a forward basis as well. So, from a T plus 5 basis, we may see a potential inflow of 900 to 1000 crores on inclusion in the FTSE indices. Again, when the next rebalance happens on September 27, we may see another 1000 crores of inflow. And this is because the free float of the stock will keep changing. On the day of listing, the free float will be smaller, but as the time passes, more and more shares will be available, and as a result, the free float will keep increasing. So, on account of FTSE indices inclusion, we may see a passive inflow of around 1900 crores. If I move to MSCI, which is the next index, again, very clearly laid out dates. March is, I think, the first opportunity at which NSE could be a part of MSCI's indices. That may result in around 3,400 crores of inflows and demand. And again, the next rebalance date post that is September 27, where we can further expect another 2,700 crores. So on the passive side, this is how we think the demand will map out. To my mind, the more fascinating aspect is the active demand. So let's quickly switch over to that. If I just look at broadly active demand, most of the local indices and mutual funds and capital market players and PMS providers, majority of them will have either BSE or NSE as the benchmark. Now, of course, NSE cannot be a part of any index run by the company. So the potential target for NSE will of course be to be part of the BSE indices. And BSE will not have a large demand from a passive perspective, but a big demand from an entry perspective. So if I see BSE, and first let us understand the mutual funds which use BSE as benchmark, because those will be the funds that will eventually over time add in terms of demand. If I look at mutual fund AUM with BSE 500 as the benchmark, that comes to about 2 lakh crores. If I go to PMSs, where the total equity AUM is 7 lakh crores, BSE 500 as an index has a larger share there. For the sake of convenience, let's assume that's another 3 lakh crores of AUM, which tracks BSE 500 as the benchmark. So we have 5 lakh crores of equity AUM with BSE 500 as the benchmark. Now, our estimate, and these are all calculations done on a today basis, if we anticipate the entry, the timeline likely for us is about June 27. So BSE will be later compared to FTSE and MSCI in terms of inclusion. And the average weight that we anticipate is about 2.2%. Now, if I just do the broad math, this translates into around 11,000 crores of demand for NSE. The other very, very interesting aspect is for the rest of the industry, the active equity mutual funds, which is about 28 lakh crores, where they are using NSE indices as the benchmark. There, this stock can never be part of those indices. In history, we've seen absolutely no instance of any exception where a stock is included in its own index. So what that does is basically for funds which have NSE as the benchmark, it gives them a perpetual source of alpha. They can participate ahead and invest into the stock and generate alpha, which will not be in the index. So that's also another source of alpha and another source of demand which can potentially come in. So, long story short, I think what we are trying to arrive at is that for the first 6 months, we see the dynamic very heavily favored in terms of demand vis-a-vis supply. And that gives us the sense that there is massive merit in subscribing to the IPO. So if you look at it from a near-term perspective, definitely you should see decent listing gains and you should see the same, kind of translating over the first 6 month period as well. The number could be, a wide-ranging number between anything like 20 to 25% to maybe even higher. But I think as an investor, there is definite merit in allocating in the IPO as and when it is open. The IPO subscription also is aided by the fact that the issue size is large. So about 30,000 crores is the IPO, and that should give the non-institutional participants enough space and size to make allocations. NSE, as you are all aware, also is very actively traded in the unlisted environment. There, of course, the prices are now higher than 2,000 rupees, is what we've been made to understand. So, to our mind, I think given the fact that as an unlisted pre-IPO investor, you will be locked in for a 6 month period, we don't see the merit in getting into the stock, buying it today and taking the 6 month lock-in. Favorable payoffs will be achieved if you rather invest in the IPO because you have the flexibility to exit as well. So that's our quick summary and view on NSE. And I think there are, of course, several events to keep tracking because exchanges on a going ahead basis, once NSE lists, will be a very large investable opportunity given the sizes. So if you ask me for the key events to track post IPO, one is, of course, and we've been saying this consistently, to very closely track the options market share and how that will pan out over the next 6 to 12 months. Uh, the second is, of course, NSE's and BSE's ability to identify further sources and products, like BSE did with Star Mutual Fund, and NSE might, keep identifying revenue and profit growth drivers. I think that is another very, very clear area to track. The last point, of course, is leadership, and this is also very, very, clearly defined for NSE and BSE. For NSE, of course, the current CEO, Shri Ashish Kumar Chauhan's tenure ends in 27 June 2027 June. It remains to be seen how the selection of the next CEO is done. And similarly for BSE also, the kind of understanding is that there will be a leadership change somewhere in mid 2027. So these are again very, very key events for us to track that we keep tracking. And I think that is where I'll pause and hand over to Aishwarya to take you through our view on BSC. Over to you.
Thank you, Bhavin. Good evening, everyone. So, thank you, Bhavin, for giving insights about this very interesting juncture of NSE hitting the bourses now. So, coming for BSE is what we've been holding since we started Fident almost 2.5 years back. The reason we got into this name was our expectations of this exchange, which is a very old exchange, haven't had done much till 2020 to 23, but then we saw those early signs of BSE gaining market share post when they came out, resigned their BankX and other products which got beautifully accepted by the broker community with aggressive pricing. So I think that led us believe that this market share gain possibly will start snowballing. And then if you see in front of you, rest is history. The way they have increased their revenue almost 5 times in the last 3.5 years, whereas EBITDA and PAT grew almost 12 times, and that what led to a sharp appreciation in the stock prices. It was primarily contributed by their ability to garner market share in the option strategy. Just for everybody's knowledge, normally exchange in India works in cash, future, and option. And option, because of the higher volumes and higher premium, is the highest profitable segment, and BSE was able to decipher that, crack into the NSE volumes, and showed such huge growth in profitability over the last 3.5 years, which market participants rewarded with the kind of stock appreciation we witnessed in that place. So this is what BSE more or less did. What really we were thinking through when we invested at that time in early 2024, the market share was in mid single digit on the option side. And we thought that the way it has started, it can possibly snowball it to 15 odd percent to 20 odd percent, and which literally played out and we stayed due the course. Moving ahead, if you look at, there are a lot of things which happened. So if you can see on the bottom side, you can see the BSE market share in options. We bought BSE in April 2024. That time it was in mid single digit. And there was a lot of uncertainty about a lot of regulations which say be bought for exchanges, whether it is increasing the size of the contract, limiting one exchange, one weekly contract, and then obviously the change in the expiry date. We have seen and been a part of this whole musical chair which played between BSE and NSE on the expiry date. Weekly expiry was converted to monthly expiry, and all these things happened. But in spite of all these regulatory changes and things that played out, we continue to see BSE's ability to gain market share. And if you can see in front of you, both BSE National as well as BSE Premium has done phenomenal job. So BSE Premium, which what is what matters, is almost at 27.5%, which has been a remarkable improvement over the last 3 years. And I'm saying that how did we played or the whole story? I tell you, BSE when we started our first scheme, which is called Fair, and you saw the performance, the first stock we bought was BSE, adjusted to all the corporate events. This was at close to 900 odd rupees. The stock by that time has already moved up three times. So it was not very easy for us to go and buy a business like this, but we were very confident on their ability to turn around on the earnings side, and the stock went up to almost 2000 odd rupees, 2000 plus odd rupees, and we were holding on to that at 2468. And then we had a lot of uncertainty coming from SEBI's dictate about days changes and a lot of restrictions which were coming, and we thought that possibly the only way this earning momentum of BSE will continue is whether they can keep earning that higher market share. And possibly with all these regulatory changes, it was difficult for us to extrapolate the same. So we took the knife and move out of BSE, and it was one a difficult call we did. Within a month or time, we got clarity from SEBI that okay, this is the way, that there will be two different days, and then we believe that now this market share story will continue most likely from here onwards. And then we got again into BSE at 2800 level rupees, and then stock moved almost I would say another 70-80% from there. As of now, we are holding BSE in our portfolio. We believe there is much higher scope of increasing the market share to at least, I would say, one third on from the current 27-28%. There is 6-10% further option market share that BSE can gain, which will help us to report much higher, growth on your earnings side. And with INSE IPO happening around, and there's limited visibility about any other player in the exchanges, we continue to hold on to the stock. We will evaluate the story every month and every quarter how things to pan out. So I think I will stop here, and I will ask Mihir to have a look on the interesting parts of various other exchanges, which are actively traded in an unlisted market, or some of them are even listed. So over to you, Mihir.
Yeah. So I think a lot of things changed when BSE started gaining market share. There was a couple of major events, primarily from the end of December 2024 to around September 25, where we saw a couple of, I would say, dormant exchanges kind of raising money. And we also wanted to see what they are doing, where they are right now, and whether there is merit in terms of Indian exchanges being the only, I would say, market where it's not a duopoly, it's more like an oligopoly, whether that is something which is likely to happen. So we start with MSCI. So before what has happened from December 24, I wanted to give a brief of what MSCI was. So MSCI was basically MCX Stock Exchange, started in 2008 by FTIL Group, which was the group behind MCX, and there was another stock exchange called National Spot Exchange Limited, where there was around a 5,500 crore odd NSCL scam. That resulted in SEBI declaring FTIL not fit and proper, and they had to exit basically all the stock exchange holdings, which was MCX and MCX SX at that point in time. That resulted in 2024, there was basically a dormant stock exchange, which had nothing to do, which only had like an index, and it had a stock exchange license. But that changed in December 2024 when MSCI, which is MCX SX, which is now called MSCI, Metropolitan Stock Exchange of India, they had their first tranche. They had raised around 240 crores from large institutional and retail brokers. And that was the first sign of confidence capital, which was put in by investors like Grow, Zerodha, Share India, and another host of investors and brokers. That was followed up in August 2025 with a much larger fundraise of around 1,000 crores from investors like Peak 15, which was earlier called Sequoia. And if you look at the investment list, it is a huge list of brokers which are interested in this stock. Now, post August 2025, what actually has happened? So there's only one large event which has happened from January 2026. MSCI is the third stock exchange which has restarted cash segment trading. Moving on to the next slide, let's see what actually it does. So what does MSCI hold? So MSCI currently has around 260 securities listed. Most of them are large caps. and around 3,049 securities are permitted to be traded on MSCI. Its benchmark index, which is SX 40, broadly sits between say 630 and Nifty 50. So while uh, there is some homogeneity between both the indices, I think there is securities kind of largely traded. MSCI restarted trading on 27 Jan 2020. A lot of action happening. A few markets good, and your traded value has jumped up from crores. Uh, having said that, currently, the value is still immaterial in the grand scheme of things. I think this is the amount which needs to be tracked by market participants to see if there is significant liquidity which kind of goes into place. In my assessment, any amount legitimate stock exchange to kind of go ahead. Uh, Moving on to the next slide. Hello. Yeah. So what kind of led to a lot of action in both MSCI and NCDX for that matter was two things. So in October 2024, SEBI had permitted each exchange a 1 week index options expiry. Using that logic, MSCI decided that Friday could be taken by SX 40, which was their benchmark index, while Tuesday and Thursday would be split between NSE and BSE respectively. Along with that, I think NCDX was also looking at maybe taking one of the other expiry days to kind of get into equity derivatives. Having said that, the entire thesis changed in May 2025 when SEBI limited the expiries of all equity derivative exchanges to only 2 days, which is Tuesday and Thursday, which is where everything stands. So Tuesday is basically NSE and BSE is on Thursday. What SEBI wants to do, and they have been very, very clear in communicating the same, is that no other exchanges will be permitted to do derivatives unless there is a liquid and active cash market. That is the statement which has been made. And to get there, I think MSCI will have to do significantly higher amounts of traded value than what they are currently doing on the cash part. There are a few optionalities which can actually trigger this to be a serious challenger. Most importantly is, I think, Grow and Zerodha's ownership in the platform. There have been market rumors that they want to make this as a low-cost, digital-first SME listing platform. Currently, BSE, NSE, both of them, while there is some focus on SME listings, there has not been a material effort to kind of revamp the entire system. And that is where MSCI can be a disruptor like how Grow and Zerodha were. Similarly, distribution, there has been both Grow and HNI brokers like Share India. They have a very wide distribution network. So if there is significant liquidity, like how you can currently invest in stocks via BSE and NSE, there can be a significant option to kind of trade via MSCI as well. And most importantly, I think the MD and CEO, who is Latika Kundu, she has a lot of experience in backed by market infra experience. And she, if you look at her track record, it has been significant. So she's worked with NSE, she's worked with a large couple of financial intermediaries, and she has a good amount of experience in kind of turning around the exchange. Unlisted share price went up as high as around 9 rupees, which kind of corrected to almost 3 rupees after the clarification by SEBI. And now it is currently trading around 5 to 6 rupees. What is our view on MSCI? So currently, while around 1,250 crores is going to go towards liquidity enhancement, we have seen some, I would say, offshoots, green shoots in terms of the same. But MSCI to be a serious challenger will need to do a lot more. A 200 crore daily turnover is not large enough. There are a few other optionalities which can come into play. Primarily, there has been a lot of slippages in block deals on both BSE and NSE. And that is one segment which they can target to get to 1,000 crore plus active cash market, which can happen. And that is the main trigger which we are currently looking for. And in the absence of that, I think there is not a lot of merit in investing on current terms. If we see material upside, I think then at that point in time, MSCI can be an interesting opportunity to kind of look ahead. The second interesting exchange which kind of pops up is NCDX, which is National Commodity and Derivatives Exchange. It raised India's leading agri-derivative exchange, around 85 to 90% market share, very close to IPOing in 2021, but then it got disrupted by regulations where 7 of the key commodities were kind of banned by SEBI, primarily because there was a lot of speculative trading, which was resulting in inflationary contracts. So, if I run through the timeline for NCDX, December 2003 was when it commenced. Primarily a branch of NSE, LSE, NABARD, ICCI Bank, and CRISIL were the initial shareholders. Then, moving on to the next, in December 21, key commodities were kind of banned. And what revived is September 2025, NCDX got in principle approval from SEBI to foray into both equity and equity derivatives trading. And once they got the approval, there was a fundraise similar to MSCI to the tune of around 770 crores. And the shareholder base, if you look, it's broadly the same. Grow, Zerodha, Share India, and a lot of other both institutional brokers and serious investors. Now, what NCDX lacks, which MSCI has, is NCDX does not have any index on its own. And I would say on a timeline front, NCDX is at least a year away from MSCI. So what MSCI has committed to start is they want to start a MF transaction platform by Q1 to Q2 FY27. And they want to go beyond the top 30 cities because NCDX was very strong in rural India, and that is where they actually want to see if they can go ahead and penetrate that. I think MF platform is just a front to kind of see and test how their equity cash segment will happen. Currently, systems, hardware, indexes, everything is being finalized. By end calendar year 26 is where the company expects to start equity cash trading, which would place them a year behind MSCI. On the derivatives front, I think it's the same. They will also need to establish liquidity buildup, and then if there is a significant amount of liquidity, SEBI might give them weekly and monthly contracts. They are expecting June 2027, which in our assessment seems aggressive at this point in time. And there was some optionality where NCDX is exploring a 20% stake in the Colombo Stock Exchange, which is Sri Lanka's flagship stock exchange. NCDX, in our assessment, fares slightly behind MSCI, primarily because they do not have anything substantial. Plus, transitioning from a non-stock exchange to a stock exchange is, in our assessment, slightly more difficult. And our investment style is not speculative in nature. We are opportunistic, we are not speculative. Whenever they kind of go ahead and get into cash, we'll kind of track and see if there is some action which is going to happen. But in our assessment, we are very, very clear that MSCI currently is the leading challenger in our assessment. Apart from NCDX, I think there has been a couple of chatter about Kolkata Stock Exchange also kind of being revived. But I think currently those are also in the works. So in our assessment, it's very simple. MSCI is the leading challenger, followed by NCDX, followed by all other stock exchanges. Quickly moving on to MCX, I think it's important to kind of track that also. So MCX, I'll not take more than a couple of minutes. So MCX, if I look at 60% of overall revenues comes from transaction incomes on the option side, 30% in the futures side. the key commodities are gold, silver, energy, and base metals. And if I look at the options derivative, that they have actually gone up by almost 12-13x in the last 3 years. And that is been led by a super cycle in commodities. And along with the super cycle in commodities was also a very volatile super cycle. So what had happened was from FY23 to FY26, gold, silver, all commodities kind of went ahead. They went up multifolds. They went up to a with a lot of volatility. So a lot of speculators and a lot of hedgers, all of them kind of were trading on MCX to kind of safeguard their interest. And that cycle, I believe, is very difficult to predict on a long-term basis. And that is why, while we are not very bullish on commodity exchanges, because we believe that the best of the cycle is over, there is some merit that whenever such a similar cycle, there is some element of that happening, MCX will be the best place to kind of take advantage of that. Apart from that, there are a few risks which we see which are materially higher for MCX versus other exchanges. So MCX currently holds around 96% market share. Both NSE and BSE have very strong plans to kind of disrupt those market share, especially NSE, which has started with a 72% market share in electricity futures, expanding into gas, coal, energy, and gold. BSE has also planned to enter the commodities market. They have not laid out the blueprint yet. And along with that, MCX platform seems to be the most disruptive on their own, because, for example, there has been 4 trading disruptions in the last 2 years itself, including 2 major incidents where there has been 4+ hour delays, which is, I would say, slightly risky for a exchange, because I think that is the only thing which it needs to kind of work on. So our view is fairly similar. We continue to monitor MCX. We do not believe there is a bull cycle in commodities. I think the best is behind us, both in terms of volatility in commodities and the intensity which is there. So the ability for MCX to replicate its last 3 years performance looks unlikely to us. On our pecking order, if we go to the next slide, I think stock exchanges are amongst the top, followed by commodity exchanges and power exchanges. And amongst the challenges front, I think MSEI remains our preferred pick. Though we do believe that Indian stock exchanges will be duopolistic at least for the next few years. That's it from us. I think uh, happy to take any questions, or I'll give the mic to Aishwarya if he has anything to add.
Uh, Thank you, Mihir. Thank you for all the insights. Just for another 5 odd minutes, let us cover on how do we see market from here onwards with all developments happening, especially today. I think everybody is aware that after almost, I would say, 20 odd days, we have again seen noise coming through on the US, Iran, Iraq, Iran and US issues. But having said that, what we believe is whatever that's happening, I believe market works with this diminishing marginal utility. That every news on which market has already reacted, market doesn't react the same way again and again. And with Brent at around 77, 78 as we speak, from the level we saw at almost 72, we believe that crude level is very comfortable. We were almost at pre-war level, and if we just adjust for this $5-6, I think India is sweetly placed. I also understand that it's very difficult to tell how this geopolitical scenario will play out, but we have seen how Trump comes and changes things overnight, so we are not overly worried about that. This is also visible on the side, like a couple of things is obviously you see whether with 10-year G6 has softened from almost 7.25 to 6.75 as we speak. And the biggest point which I want to highlight here is that there is obviously a concern on Q1 FY27, which is obviously starting from today, and that there would be things will be under pressure in coming times. We, however, believes have a slightly different view. We believe that Q1 FY27 will be more or less like a surprise. We are very comfortable with the way we got insights about various companies we have met over the last couple of months during those times. So the revenue growth trajectory will be much higher compared to what we saw in quarter four, but profitability will not be impacted that much. So that we believe possibly will be a manageable quarter in that scenario. Second thing is obviously what we are seeing globally, there is a kind of risk of sentiment playing out in the last 2 weeks or so. And interestingly, in India, after 6, 7 months, has actually outperformed. So if you see the last fortnight data, FIs has actually bought India to the tune of 14-15 thousand crore, where they were like, we have seen almost selling of 20s. In almost 21 months, we have seen a selling of almost $60 billion or so. So it's a very small time frame, but we are obviously seeing that India is now showing signs that there's an outperformance of India compared to the MSCI emerging market and things like that. So the FI selling is clearly awaiting. I believe macro resilience has clearly been proven during the tough times in the last 3 months, and valuations are definitely making a lot of sense today. What we understand is India is getting its mojo back because somewhere down the line, the global investors are not overly comfortable in markets like Korea, Taiwan, where obviously they have very high growth and things like that. But the volatility in those markets has increased manifold. If you see this YTD, there has been 4 times when Korea has hit lower circuit. There has been 78 to 80 days where when seen Korea and Taiwan market has moved more than 1% compared to almost 30 days over Nifty has moved more than 1% in a single day. So possibly India will now be looked in more different lens in the coming times. Possibly it will be seen as a hedge for AI vulnerability. And at the same time, when the earning trajectory picks up, I believe India will become, a global go-getter for major of these investors. And why do we believe so? If you just see on to the next slide, there are certain areas which I want to bring to everybody's notice, which I believe can't be overlooked. First sign is obviously our credit growth into the system. If you see the last fortnight, we have crossed 17% growth to almost 2 lakh, 2.15 lakh crore. There is a very strong relation between how the credit growth happens compared to what the economic activity. And this is coming in spite the time when we have seen the last 3 months, the crude prices has been hovering around $100 plus, which obviously have a negative impact on across asset classes or on the whole macro perspective there. So I think these are telling us the signs that things are, coming for good. Again, if you look at on the other side about how there is an intensity of private capex picking up, right? If you look at, like as I mentioned to all the management that we met in the last couple of months, there's like 40-50 management companies we met. The one thing which has come out very clear is that the demand momentum is very strong, and to cope up with the demand momentum, everybody we met are making their capex allocation there. That gives us insights about what the promoters are thinking, and that we believe is possibly will help us to make sure that we grow above 6.7 to almost 7% growth, at least for the next 2 years. If you connect it with the way profitability is happening, we have seen that the corporate profitability as a percent of GDP is all-time high at 5.2%. Second thing is obviously because the crude has gone down, so obviously the inflation fear is possibly out of the window. There are also the risk of sharp earning cut is also been taken care of. So see, for India, one thing is very important. If crude comes at a comfortable level, whether it is CAD, whether it is inflation, whether it is your fiscal deficit, everything comes in place, or whether it is BOP. So we are in a very, very sweet spot. And on the same other side, we are seeing those corporate profitability increasing much, much better. So as I said, earning expectations possibly will not be as bad as market is fearing, as the commentary that we have got the insights from various of the management that we have been meeting through. Certain other data, like, if you see as I said, like, the first time in the last 6, 7 months, we have seen India outperforming EM. So where the India went up 2% up in June, MSCI emerging market was negative 2%. So that rotation is very, very interesting. And we should give kudos to RBI, the way they have managed the liquidity, the FCNR, the all that initiative to support currency. Obviously, currency is still on the loose end, but all the initiative to make sure that growth is accommodative, and you do everything to make sure that macro remain resilient. RBI has done a phenomenal job. And if we connect everything with the valuations, I believe the last 2 years of drawdown is possibly we'll see a mean reversion in the coming 1.5 to 2 years. Nifty is trading at almost 18.4 time PE, where the growth, which was almost in mid single digit, 4-5%, possibly will be an upward of 13-14% for FY27. In quarter one FY27, even Nifty growth is expected to be close to around 9% or so, in spite of all the commodity-led inflation. So overall, we are very, very comfortable. We believe this is a very sweet time. Days like this are opportunities which you will not get much ahead, because this narrative will keep dying as things progresses. And we remain comfortable with the way India's macro has improved, especially in the last 3-4 months, given the way the crude was hanging all high. So I think I will stop here, and Bhavin, if we can move on to the Q&A session there.
Sure. Thanks, Aishwarya, and thanks so much, everyone, for staying on the call. I know we've slightly overshot on time, but would love to take any questions or queries. Feel free to post them on the chat window, and we will address them one by one. And while we wait for the chat queue to and the queries to populate, maybe in the interest of time, Aishwarya, I'll preempt one question or a couple of questions, and maybe we can cover how our fund portfolios are positioned at this point in time while we wait for other queries to come in.
So, like the fair is a flexi cap, and if you look at how the portfolio has been standing through, so there's almost 50 or 51, 52% allocation is to large cap. Over the last 7-8 months, we have increased our allocation to small cap. Small cap is actually around 40% as we speak today. On quant side, if you look at the growth in the portfolio, historically has been almost three times of what index has done. But we're looking forward, the growth looks at almost 21% compared to 14% on indexes. So growth is much higher with better return ratio and low debt. Our valuations comfort is much, much better compared to what we have seen it for the index. So this is like a very high quality portfolio which has been able to manage, very good, I would say, growth. And especially this portfolio has completed 2 year, 4 months. And we believe that we have been brutally tested in a tough market like this, and then have been able to deliver a decent alpha over the last 2.5 years. So if you see on how this has done, I think we already show initially, but we can always revisit. And coming to fiber, which is basically the thematic portfolio, where we primarily invest into broader market themes who are beneficiary of the government reforms and the government capex. If you look at the portfolio here, there's allocation to small cap is almost 84%, with mid cap to almost 7%. So mid and small cap is almost 91% of the portfolio. This portfolio completed 2 years in June. And if you look at the quants, I believe there is a lot of comfort on that side. So not only the growth historically has been very strong, the forward growth also looks very compelling, with almost roughly two times of what index is doing, and with high ROE, low debt, very strong balance sheet. And what is really comforting is the way we are able to buy those companies at a very attractive valuation. So, both Fair and Fiber completed 2 years, have been able to generate alpha of almost 6 to 7%. Similarly goes with Fair. So, Fair is a high quality where you have a large allocation between large cap and small cap, whereas Fiber is more thematic, more bottoms up, where we have higher allocations to small cap and mid cap. One thing which is pretty common is that in both the fund, our small cap allocation is higher. In flexi cap, we are at almost 40%. In fiber, we are almost at 83%. That tells us that how much comfort we have on the growth element in the small cap space, as well as the valuation comfort. So if I just to give an example, like when we started 2 years back, there were a lot of good companies in small cap space. When I say small cap, so AMFI definition is pretty different, but I'm talking about companies between say from 3 to 4,000 market crore to say 10, 12,000 crore market cap companies. Many of them were able to manage 20-25% growth, but they were all trading at 25 to 30 times P 2 years back. That thing has actually seen a reset. Now, a lot of these companies which are still able to manage 25% plus growth, a lot of these uh, companies with good thematic exposure, now majority of them are able to are trading below 20 time PE or 1 year forward. So that comfort on valuations where the earning growth has remained resilient gives us a lot of comfort that why we have a higher allocation to small cap across the space. So we at Fident believe that this mean reversion in small cap will play out beautifully over the next 1.5 2 years. I think we are not at all worried about this geopolitical situation now. It has been market has digested it beautifully. So there is will be news noise coming through this and there, but that will not see a sharper reaction to that, or possibly at least on the macros and the earnings side, because we have seen much higher level of crude and we're able to manage that show. So overall, things looks positive. Only one big risk, which I believe is something where market is still not discounting it, is possibly, I would say, if there is a global meltdown happen on AI-led stories. In that context, India will possibly a beneficiary because India is more broad-based and possibly will act as a hedge. But when the global risk of happens, possibly India will also fall initially, right? That's the one risk we should be aware of. Other than that, we I think are very, at least from India domestic perspective, one risk about rain and El Nino was around, which I believe has been taken care of. We have seen huge under recoveries of rain being covered in the first 7 8 days of July, and we believe this trend to continue. So there is no much major macro risk domestically that we am really worried of, and that gives us a comfort that possibly money from FIs will start rotating to India.
Thanks so much for that, Ashwarya. Let me take a couple of questions as they start coming in now. And of course, the first topic is Indian IT. Your quick comment, Ashwarya, on how we are positioned, particularly in FAIR, with regards to our IT exposure, and what do we expect going ahead here?
Yeah, so quickly, obviously, Indian IT has been the benefic had been facing the adversity on your whole AI story. There's obviously a risk of deflation on AI-led businesses, and which is also visible with many of the analysts penning down the growth to low single digit, 2 to 4% kind of a number for the large cap, or say 7 8% number for the mid and small cap. We didn't believe that possibly this is exaggerated. I think there is too much of pessimism which is playing through. We are not saying that AI fear is not there. AI fear is definitely there, but the pace and things will all take time. And the comfort that we have comes from the fact that if you see the last 5 quarter or so, the deal pipeline looks pretty promising, and integration of AI into this legacy system will all take time, and there will be those Indian IT and the global software companies which will possibly will be the agents of change, and then that's why things will change, the nature of businesses will change. But I will not bet against the jugaad of the Indian IT companies. I've seen it every 4 5 years. There's a change of technology, things goes heavier, and then they come up very well. But what gives us more comfort is the valuation. So if you look at the large cap IT, they're trading at 12 13 time PE. Now, if we compare it to global players like Cognizant or Accenture and players like that, they are trading at 10 time PE. Historically, their valuation gap has remained almost to 2 time multiple. Now things are gone to a very, very pessimistic scenario. So if we do DCF on majority of these companies, the terminal growth is not even 1%. So we believe there is a lot of pessimism which is playing through. If you see the last, and that's why we believe believe that there are companies which will be able to create a meaningful alpha from a 2 years perspective in that space. That's why we are overweight on IT. Even if you see the last 1 week or so, at least in this July, there has been almost 14 15% recovery in Accenture and Cognizant stock prices, and then we saw the similar number playing out for some of those Indian IT company players. So obviously, whether it's a dead cat bouncing or only time will tell, but we have a lot of comfort on valuation, and we don't believe that there will be a very sharp cut on the revenue momentum of this majority of these IT companies as what market is expecting, and that gives us the comfort to create alpha from that perspective. So that's what we believe on IT space.
Thanks so much, Ashwarya. Let's just quickly wait for a minute and see if there's anything else before we conclude. Another question coming in terms of our views on solar module players and that segment.
I think I should ask me to speak it in more detail, but in fiber we play themes. In fiber we play themes where we see a lot of government capex or possibly sectors which are beneficiary of reforms. And we are very positive on power as a space. And solar has also been one of the area which we have discussed a lot. But in fiber, currently, we don't have any names in that space. The reason being, we obviously when we started fiber, the valuations of majority of these solar modules and things like that, were pretty high. They were at 40 to 60 time P, and we were bit skeptical about the overcapacity situation, and with China being around the corner. So we realized possibly this business is more kind of a business with a very low moat around it. And this obviously there's a lot of growth, but there is no business company which possibly is not insulated from pricing cuts and things like that. So if you see a lot of these companies even today as we speak are growing heaps and bounds on revenue and capacity expansions and things like that. But majority of their companies valuations are now have dropped down from 40 50 times P to almost say 20 time P or something like that. So I think market is not very comfortable with this overly competitive scenario with overcapacity on modules and cells and things like that. And again, China being around, so that's why they are not getting that premium. Which and we believe it's pretty difficult also, until unless if any of this company do something meaningful on battery storage or something, they diversify and do something where they have that niche on getting this pricing correct. So one has to be very careful into any company, whether it is diversified or things like that. With a caveat, we are ignoring this segment as for now. Mir, if you want to add anything.
Just I'll just add on a few things. So why we don't like solar players? I'm assuming the module also refers to cell and eventually wafer. So what happens usually or what has happened in solar and what we expect to continue is basically you have regulations, government regulations, which is kind of aiding a disproportionate amount of profitability for the solar players. What you've seen is only the early adopters kind of make disproportionate profit. So someone like Vari, who is usually has a much larger capacity in modules and now sells and eventually wafers, they'll make a substantial amount of money for a short period of time, and over time the margins will kind of go down. So the current margins and current profitability which all the companies are having, we see significant risk to earnings decline over the next 2 to 3 years once everything kind of settles. Secondly, other segments, while there are a lot of companies trying to diversify, the amount which might not be sufficient enough to kind of offset a lot of pricing pressure which they'll see in module and solar. So earnings uncertainty is kind of keeping us away from investing any of the players. Having said that, if we had to kind of actively look for one companies, I think Vari or Premium Energies would be the ones which we probably be more interested in.
Thanks, Aishwarya and Mir. Let me go on to the next question, and it's a very interesting one. Any global exchanges that we like? Uh, and let me clarify firstly by putting across our submission that we are more India focused in terms of what we track, and opportunities for Alpha are mostly focused in India when we look at stocks and ideas. But Mihir, Aishwarya, if there's anything globally that looks good or you want to just quickly highlight.
So current earnings acceleration is definitely in Nasdaq, where you will see a lot of large sized IPOs kind of getting listed there, and that is where you'll see a lot of earnings acceleration. Primarily after SpaceX, you'll also see Anthropic, you'll also see OpenAI, and then eventually the second and third wave of IT or AI coming through. I think there is some, I would say, short to medium term kind of boost to the entire revenue and profit trajectory. Having said that, honestly, we are India-focused investors, and we kind of do not tend to stray away from our expertise. So take it with a pinch of salt. I think Nasdaq is the one to look for.
Thanks, Mir. And I must also add to Mihir's point earlier when he was comparing India versus global exchanges. I think in terms of the revenue model itself, Indian exchanges benefit big time with the fact that they don't have a fixed lot size pricing, and their revenue models are linked to the value of the turnover. So I think on that count also Indian exchanges stand out in terms of their growth and valuations when you look at compared to global. The other point I wanted to quickly highlight, and this is more India specific, in light of a lot of unlisted stocks, and if you go through our report, we've covered them in fair length and detail, trying to look at various segments and modules and players there. But I think the common theme that I would like to leave for everyone's benefit is that for exchanges, as we've been highlighting all through, the moat and the ability to create products and revenues and volumes is significantly higher. There have been a lot of opportunities on the unlisted side in the last couple of years, which have sprung up given how BSC has performed and given how the share price has appreciated. Our submission simply is that I think we need to look beyond those narratives. We really need to track closely and see how much of those narratives are playing out. And there is, not a lot to gain by speculating and being ahead of the curve in terms of trying to predict who the next exchange will be and what the outcomes will be. Even after the entire market share gain started for BSE in options, there was significant money and alpha to be created even post those events playing out. So that is, I think, another point that I thought would be worth leaving for everyone. Try and look at more actionable data points, more real changes rather than relying on narratives is one thing that I thought I'll add. We have another query on recycling uh, in terms of the focus that the government is showing and the ESG norms and the compliance that increasingly countries are taking up. Aishwarya, would you want to take this quickly? What we think of the recycling sector, any opportunities we
Yeah,
see?
so this is also one of the very interesting theme which we like. And we unfortunately have not been able to zero down on any stock in our portfolio. We have been evaluating many of this company in that space. We believe there is a very strong tailwind of growth, given the the need of the recycling and possibly the the scarcity of the many of these products which are there. Uh, I won't say water is recycling is a part to this, but this is also a kind of a proxy quasi play which we were interested, and I think there's a lot of new stocks which are making a lot of headlines recently. So I would say, for investors, this is one area if you have a 3 to 4 year view, themes across, whether it is plastic, whether it is metal, or even some other segments on batteries and all, lead and all that. There's a lot of good companies which are going to see their businesses growing up strongly, but nothing we own so far. So the reason for us not owning many of these companies is either we have got some, governance issues, or possibly the valuation doesn't make any sense compared to what the growth into some of the companies. But we are working hard to get one of the name in our portfolio.
Thanks, Aishwarya. I think with that, we've come to the end of the Q&A. Let me conclude by thanking everyone again for your time and patience for joining on the call. I hope you found the insights on exchanges and our market outlook useful. Look forward to engaging with you through many such future calls. Thank you so much.
Thank you so much for everyone.